In general, a company should secure an offtake before it needs a loan to finance a project. And so the precise timing really depends on the maturity of the company's technology and the market into which it's selling.
Hi, everyone, and welcome to Climate Tech 360, where we connect with diverse voices in the climate sector to make informed choices in supporting the future of climate technologies. I'm your host, Samia, and today we are talking to Kobe Weinberg. Kobe has worked in a variety of roles in climate finance, from early stage investing to insurance. Currently, he is a senior manager of strategic initiatives at Creo, a nonprofit think and do tank that seeks to mobilize $1 trillion in private capital for climate and sustainability solutions. Previously, Kobe was the impact associate at Nephilia Climate, a climate risk hedge fund. For the past 4 years, he has also been the managing editor of CTVC, a newsletter which I'm sure you are all familiar with. He's a fellow and guest lecturer at Brown University for a course that he co-designed called Finance and the Environment. Kobe graduated magna cum laude from Brown University with a degree in environmental science. He lives in Chicago. In this episode, we cover pretty much everything you need to know about offtake agreements. We start out with the basics. So what is an offtake agreement? We talk about what the buyer looks for. We talk about what lenders might look for in offtake agreements before issuing a loan to a startup. And we go through case studies. Kobe wrote an excellent paper on offtake agreements, which I have linked in the show notes, which you can reference as well for more detail. And now on to the episode. Hi, Kobe.
Hi, Samia. How are you?
I'm good. Welcome to the podcast.
Thank you for having me. I listened to the show and I always learn something new, and I really appreciate what you're doing for the climate community and beyond. This is also my inaugural podcast.
Well, first of all, thank you. I think that makes me happier than anything, really, when people say that, because you are my target audience. I'm doing this so that people within the climate community, we can address the problems that we're facing together, right? How do you scale and commercialize these technologies? And then on the inaugural podcast thing, I know you're coming out with a few other reports, so I would like first dibs in the future.
You've got first dibs. Not too many people knocking on my door yet, because some of these topics are still a little bit niche within the climate community, but hopefully with your podcast, more people will be asking. So
yeah. Oh God, no. Honestly, the paper that you wrote on offtakes was so helpful. I've read it multiple times and I've referenced it. So this episode is really going to be a conversation about offtake agreements. And I'm going to link your excellent resource in the show notes. But before we get into all of that, into the basics, I would love to know how you started researching and analyzing the space.
Sure. So it really stemmed from ongoing discussions about how early stage climate companies, really those that need to build infrastructure scale, first of a kind projects. So, think about like $1 billion plus projects, not necessarily the 50 million range or 100 million range, but like how do we get to those huge commercial facilities in steel and hydrogen and direct air capture? And those companies, as they move to larger scale facilities, they need to shift from venture capital funding to debt financing. And, folks have labeled this sort of capital chasm that exists for building early stage projects and them not necessarily looking right for venture and not necessarily looking right for debt as the missing middle or the second valley of death. The reason that gap exists is because there is a risk return profile change as you move from one to the other. So venture capital takes on an extraordinary amount of general execution risk of a company, a company that's typically at the stage of technology development, while debt underwrites sort of the idiosyncratic execution risk of a particular project and the technology's deployment. So, you've moved on, you've proven that the technology works. Now let's, put it in the field and have it function. And so as the saying goes, with great risk comes great reward. And so when venture capitalists, when they're investing, they project returns around 30% plus, while lenders, they're projecting returns in more of the mid-teens. In the venture community, there's sort of an air that projects should be invested in and that debt providers should participate in funding these projects because they're climate technology projects. And we need to decarbonize and reach net zero, so they should be helping that sort of mission. And while I agree with the general sentiment of that statement, or that like sort of air, is I have not really seen debt being flexible and agreeing to underwrite additional risk. And so the question that this paper and subsequent papers really gets at is how do we move from equity to debt? And that really requires risk management and risk limitation. So my research has been into what are some of those practical steps a company can take to remove or transfer financial risk, and that sort of brings me to this first paper on offtakes.
Yeah, that makes complete sense. I've talked about this on the episode on project finance, on the episode with Zeev on debt and venture debt as well. Debt is just different. I mean, you're not taking the same kind of equity risk, and people don't understand that. And there's almost this I don't know what the right word is, but this feeling that it's the responsibility of debt providers to step in and take on that kind of risk. And that's not how it's structured. So it's really important for people to understand that and to think about how to de-risk that. So let's start with the basics, if that's okay. What is an offtake agreement?
So an offtake agreement it's a contract between a buyer and a supplier of some output. So for example, it can be a data center that is buying 10 megawatts of electricity from a wind farm for the next 10 years, or it can be a construction company purchasing 10,000 cubic yards of sustainable cement for the next 20 years. And these contracts, they're a little bit different than others you might see in press releases because sometimes you'll see letters of intent or memorandum of understanding. And these contracts, they don't have teeth. While offtakes do have teeth. They are legally binding, right? And so offtakes at the end of the day, they can help the buyer and the supplier of the output, but in different ways. So the buyers want to lock in long-term agreements for products that are scarce or are subject to price changes. So, sometimes they'll agree to 10-year contracts because they're able to get a discount for that product or that output. Suppliers benefit from having that predictable cash flow and demonstrated demand for the output they are producing. So basically showing that there's product market fit. And for the suppliers, you get another added benefit, which is with that demonstrated demand that comes with securing an offtake, you can unlock non-dilutive financing and fit for purpose capital, which in this case, I'm mostly talking about debt. And so companies that raise that fit for purpose capital, they generally have better alignment between the source of their capital and the use of funds, along with a lower weighted average cost of capital, because at the earlier stage, companies are mostly equity funded. And so as you sort of balance out the debt to equity ratio, you can get closer to more of an optimal point on the WACC curve, which just is the acronym for weighted average cost of capital, and overall have a greater ability to raise additional funding because there's less risk.
We're already jumping right into the WACC curve, huh?
Yes, I know. It's getting whack. All right. Probably cut that part out.
I'm going to leave that in. All right. So that was a great way to explain it. When I think about sort of all the parties involved here, you talked about three. So namely the supplier, which is the startup in this case, the buyer, which could be like a corporate, let's just say it's somebody like Microsoft's data centers. And then if the startup wants to raise debt against this offtake agreement, then there's also the lender. If we could go through both the corporate and the lender and talk a little bit about what the corporate would be looking for in the offtake agreement, and then also what the lender might be looking for.
Yes, absolutely. And some of those factors are going to be similar. Just the way that they're going to look at them will be a little bit different. So for a counterparty, what they would care most about, or the buyer, or the corporate, whatever you want to call them, they'd care most about price, like how much do I need to pay for this product, the volume, is there enough of the product that I can buy that's actually meaningful to me, the actual physical delivery, how am I going to get this thing? And, is it going to be delivered to me or do I have to go and pick it up? Non-delivery, like what sort of recourse do I have if, I've agreed to buying this thing, but what if it doesn't get delivered? What sort of recourse do I have for overcoming that? And then also the quality and the spec. So how does this product that I am now buying compare to the existing product that I'm buying? Or if it's the first time, what is considered quality? Like what is considered good? So on that price side, that's probably the first thing the counterparties are going to look at. The thing that sort of maybe would cause hesitation for buyers is fixed price, but that's also sort of one of the main components for
a lender,
for an offtake that financiers want, or the lender, what they would want to see. And so they typically want to see a discount though, if there is a fixed price, or this might be the only thing that they're able to actually get when they need to decarbonize it, or it's like the cheapest method that they can do to actually do it if they have net zero goals or things like that. And to sort of understand what that fixed price looks like, they would look at the spot market, or which is just like, the liquid market that you can look at for whatever the industrial commodity is, and see what the premium is associated with getting that sustainable product. It's sort of interesting to talk about this in terms of carbon removal and hydrogen markets, because for those products in particular, the cost is expected to decrease over time, especially as these technologies become more efficient and supply grows. But and what I've seen some counterparties include in their negotiation is some of these most favored nation clauses, or MFN clauses, which basically says that as you, the company, negotiate subsequent agreements. So let's say for the first contract, you're agreeing to $100 a ton for a carbon credit, and then in the next agreement, you agree to selling it for $90 a ton. That first agreement would be retroactively corrected to say, hey, you're now selling this to me for the next 10 years for 90 instead of 100. For financiers, that causes a lot of hesitation, because basically your ability to pay that loan on paper would look like it would go down, assuming that output stays the same because price would decrease. So I've actually seen this trip up some companies when they want to go and get debt financing, because counterparties have asked and companies have agreed to those sort of terms. And the companies aren't necessarily thinking down the line, if I need to go and get a loan based on this offtake. So they might agree to some stuff that might actually hurt them.
I was just thinking, for removals, then would you see shorter contracts? Would you see the term being shorter instead of like 10-year contracts? You might see like a 2 or 3 year contract.
I think that, I've seen some 5-year contracts, and I've seen some 10-year contracts, and I've seen longer term. The thing about in general, I think folks want longer term contracts because it just makes you more confident as the company of, I'm going to build this big facility. Like, I want to make sure that there's somebody on the other side buying this. And the fact that carbon markets are voluntary right now in a lot of places and not compliance, this is sort of it's a nice to have for the people buying it. It's not a need to have. And so
Right. It's
you
optional.
want to sort of transition that into like, hey, you and I both have a contract that we have signed saying that you're going to buy this, and I know somebody is going to be there on the other end to purchase the carbon credit. So in terms of the tenor, you want it typically to be longer so that it matches the length of the loan.
Yeah, no, that would make sense from the startup's perspective, from the supplier perspective. I just wonder if in that scenario, whether the buyer has more leverage there, because they're like, hey, we're paying for DAC at $800 a ton, but we're only going to do that for a year.
I would say that, as unless carbon starts to be taxed, the buyers will typically probably have a little bit more power in those negotiations than the companies
Yeah.
might.
Yeah, that makes sense.
So that's just one of the considerations too. And then the other thing that, to continue sort of going down that list, if it's helpful, is the volume. It really depends on the output, but it has to be substantial enough to go through that legal process of agreeing to terms in a contract and then signing that contract. Delivery is also an interesting consideration for the counterparty, because they will think about, when do I want to take ownership of that output? Do I want to do it at the factory, right? So as soon as this output is produced, let's say it's sustainable steel, do I want to go and pick it up there? Or do I want to have the company sort of handle all the logistics of getting it to the construction site or whatever it might be? There are situations too that I'm seeing where you can't get physical delivery, that people might buy a credit. So we see a lot of this in renewable energy markets, where a company wants to get to 100% renewables, but actually doing that with the current grid that they're plugged into is not really viable. So they might go out and help to develop a renewable energy project in a different grid, or they might buy a renewable energy credit. So a renewable energy credit, or a REC, is generated with every megawatt hour that's produced from a wind farm, a solar panel, or any sort of renewable source. And so you can go and buy those to basically show that you are paying that green premium to help to bring clean electrons onto the grid, and therefore claim that you are moving toward 100% renewable. And so that general system is called a booking claim system, and it can really help to decarbonize heavy industry and sort of transport value chains by overcoming the physical delivery challenges that can be associated with an offtake. So a booking claim system allows producers or suppliers to book emission savings of the good that they have generated in one place, and then for the buyers or the customers to claim the emissions benefit for the good of decarbonization in those efforts in another place. So, it's unclear for certain types of emerging climate technology projects whether those systems will be used similar to how they're used in renewables. But I could see that coming up for, hey, I am creating clean or sustainable cement and it costs X amount more than traditional cement. So I'm going to creditize or commoditize that green premium and make that a tradable credit. So if I'm a construction company and I maybe have a lot of embedded carbon in the building that I've already constructed, or I'm building, but I can't actually get the cement to where I am, I'll buy those credits to show that I am building a sustainable building.
And are there standard features like the example that you gave with cement, low emission cement? Is it standard to have a contract of a certain length? Is it standard that the buyer is responsible for delivery? Like, are there certain terms that are standard depending on what the offtake is? Like for hydrogen, there's certain standard terms for removals, or is it just the Wild West?
It's variable is what I would say. And specifically when you talk about physical commodities like steel and cement, offtakes are not typically used in those industries. Many times you'll see buyers going out to purchase sustainable cement, weeks or months in advance, not years in advance. And there is a pretty open market for being able to access those. Whereas electricity, that can be a little bit more constrained and you want guaranteed electricity coming to your data center. It's just not the same market dynamic. So that can also influence the length of the contract that you'll agree to.
Okay, so it really depends.
Yeah, it really depends. The other two considerations for buyers are non-delivery. So thinking about, I have purchased this output or this product, what happens if it cannot be delivered on time? Like, what am I able to do about that? So depending on the output that's delivered, the onus is usually on the project developer, project owner to find a like for like replacement in the event of non-delivery. So finding a replacement is pretty easy for energy projects where the owner can go to the spot market or just whatever the financial market where commodities are traded for immediate delivery is and go and find a replacement. But in some of those situations, that energy might lose the sustainability characteristic that buyers initially wanted because you're not necessarily going out to buy this clean electrons. And there's not really a spot market for cement or steel right now. You can't just go out and buy that. So you have to go and buy whatever the existing commodity is, and also lose that sustainability characteristic.
So for something like removals, it might be like, all right, so you have an offtake with a direct air capture company. They've realized they can't deliver all of this in terms of volume. So they then have to go out into the market and find something that can be replaced. And if it's not direct air capture, maybe they go to something like enhanced rock weathering, but then is the permanence the same? There's all sorts of things that they have to look into, right?
Yeah, an electron is an electron. A carbon credit is not always the same as other carbon credits, right? And there's been ongoing discussion about this in terms of if I help to like a DAC credit has usually pretty high quality. If I go and use another source, maybe a nature-based source or something like that, where it's hard to prove that additionality and hard to demonstrate that carbon is being sequestered, how would the buyer react to that? Typically, they want those like for like replacements, and quality is one of the big indicators of that. So that's like one of the things to think about there. We were sort of getting at this point, but in terms of like quality and spec, for outputs that have variable quality, there are really two groups of arbiters on whether or not that output stacks up. So you have some of these standard setting bodies or certification bodies that can be like nonprofits. So for materials and products and some services, you'll have ASTM, which is where a lot of the sustainable cement companies will look to be like, hey, this amount of cement that I'm producing sustainably is the same as just traditional or industrial cement. Or sometimes governments will help to do that. So, the USDA does that for American agricultural commodities. And these organizations, what they'll do is they'll provide seals or labels or grades as sort of symbols of quality and integrity of those products. There are some situations where the off-takers themselves can be the arbiters of quality. So maybe with a sustainable steel product, they'll put it to work and say, hey, this is working the same way or not, and just say, yep, it stands up to par relative to the stuff that we already use. And you won't necessarily go through one of those other types of organizations.
Okay, that makes sense. What about on the lender side? And this is, I think, something that startups should really consider, because when I had the conversation with Barclays, they said they really like to get involved with the startup as early as possible, because if the startup's already negotiated the offtake agreement and the lender looks for certain features, then you can't change it, right? So the earlier you can get the bank involved whenever I talk to startups about project finance, they're always like, oh, no, I can't go to the bank. I'm not ready. And it's like, well, just have the conversation, because to engage in that conversation ahead of time is so valuable because they can guide you towards the key terms that they need in order for you to be able to raise against that. So what are some of the things that lenders might look for?
So in general, lenders want to make sure that they get paid back, right? So there's sort of four primary factors that some of which are similar to buyers or counterparties that they're going to care about. So one is price, another is volume. I would say the buyers who are actually sitting on the other side of the contract, and then also the length of that offtake. So on price, financiers, when they're providing project capital, they typically want to see that fixed price that we talked about before with annual escalations of maybe around like 3% or so, and then also adjustments for market conditions like inflation. And this is particularly true, I would say, of emerging climate technologies. And if some of that output is not included in offtake, financiers, they might be willing to take some of that market risk or some of that spot market risk by selling that output, sort of elsewhere and seeing if there's some upside that they can gain. But typically, they want to see more of a fixed price with that. On volume, they want to see enough locked in to at least cover the debt service, which is just the amount of cash needed to pay the required principal and interest of the loan.
That's important.
Yeah, I would say that that's a really important characteristic for companies to be thinking about. And then they also want to see typically around 85 to 95% of total volume. And again, with all of the numbers that I'm providing in this discussion, they're mostly indicative and based on some of these conversations. These are just meant to be at least to have for companies to have a North Star with some of this. So they want to see that 85 to 90% locked in. And as a baseline, most loan agreements require like 70% of total volume at a minimum. And they want to see the total volume being close to, but not necessarily at 100%, because that provides a really useful buffer for all parties involved in case there's some sort of output shortfall. Because payment responsibility for output shortfall, that could end up falling back on the company. And so it's important to provide some of that buffer. In terms of the buyers, off-takers, they want credit-worthy buyers. And so what does that really mean? So they want buyers that are going to pay their bills, and an entity's creditworthiness is based on many factors from profitability to management quality, but it can really be deduced from data like repayment history, scores from like traditional credit rating agencies like Standard & Poor's or Moody's or Fitch, or from FICO scores. And it's typically a few large counterparties that will form the anchor for an offtake. So that can be municipalities, it can be corporates, it can be utilities. And then there might be some smaller contracts that exist to really round out the total output. Ideally, these larger counterparties will have strong balance sheets and liquidity, if not having that investment grade credit rating. And this really helps to increase confidence in the lenders for that offtake. The last component is on length. So most offtakes are about 10 years or more, 10 years or longer, and should extend beyond the length of the loan required to construct that project for surety of cash flow. Yeah. Lenders prefer these longer agreements with a quote unquote tail, like where the offtake is longer than the loan, because these longer agreements, when they have a fixed price, it really hedges against market volatility. The other option, which is I think another consideration, is for shorter term agreements that are maybe 5 to 10 years long with a fixed price. They can be beneficial if a project's output is expected to potentially increase relative to the off-taker's price over the lifetime of the project. So that's sort of another characteristic. The other thing to think about as a project, which I've heard in conversations with biofuel companies and some others, is the default of the financier is to ask for that offtake, but you don't always need the offtake. If there's a proven liquid market for the output, you can sometimes get through that process without locking in. So I think that there is also a general sentiment that offtakes are necessary for any sort of climate project. And, everyone's sort of asking about if a renewable energy project is being built, does it have a PPA, does it not? These markets some of them are developed enough now that you don't necessarily need to lock in that offtake agreement. And maybe that can actually accelerate your process of development. So that's just another thing to sort of highlight.
That's a good point. So this sounds like a very lengthy process, which also leads me to believe that it's probably pretty expensive. What's like the range of price that this could potentially cost a startup? And then in terms of timing, what's the range in times? Because when I was having the conversation with Barclays, they said sometimes they can be working with the startup for up to 2 years. And I mean, if you're working with a buyer for 2 years and then you're working, maybe there's some overlap there, right? And then you're working with the lenders. That's a really long period of time for a startup.
Yeah. So let me start on the point of cost, because I feel like that's sort of a shorter and easier answer.
Yeah.
But on cost, there are a couple of things to consider. There's the relationship and partnership development, which is just a big time suck for employees, and that can take, you're paying people a salary, and this could take up their entire days, weeks, or months or years. But then there's also the legal fee component, right? And so on legal fees, what I've heard or seen is typically around 10,000 to 50,000 for a project. It really depends on the size, and the offtake transaction cost is usually not a very high percentage of the total project cost. It should be less than 5%, usually like less than even that, maybe 3%, 2%, and so on. The thing is that bigger law firms that maybe have more experience with some of these, or just have a lot of lawyers on staff, will probably be more expensive. And, some of the bigger law firms that specialize in this and do a lot of this can be, Norton Rose Fulbright, Aiken Gump, Baker McKinsey. What I found interesting is there are some startup law firms that are trying to do more with maybe carbon removal offtake. So actually, after I published the paper, there's a law firm called Skylight Law that reached out, which is just two people that are spending a lot of time looking at DAC projects. But once the terms are negotiated, and then you're sort of off to the races. In terms of timeline, it really varies. In general, a company should secure an offtake before it needs a loan to finance a project. And so the precise timing really depends on the maturity of the company's technology and the market into which it's selling. And so companies and buyers, really those that are working with first of a kind projects or some of these emerging climate technologies, there's a balancing act, because sometimes they'll seek an offtake too early and agree to a price that's below what is needed for the project to succeed or break even or profit. And also, like, taking more time before locking in an offtake can also allow for more accurate price discovery. But then on the other hand, waiting too long to secure an offtake can delay a project's ability to attract debt financing or non-dilutive capital. And so based on some of my discussions with banks and project financiers and insurers, most climate companies negotiate offtake terms maybe 6 to 18 months. Like, that's how long it takes to discuss with each buyer, and then aim to sign the contracts 3 to 15 months before a project's financial close, which is the point at which the terms of the loan are, they've been reached and the money gets transferred. So again, depending on the size of the project and maturity of the technology, the entire timeline can be anywhere from 9 months to 3 years to really sign that offtake and to receive the funds from a financier.
Yeah. And that's where it can also make sense to get the financiers involved earlier on, so that they're involved in the process. And also they can give you advice if you are setting up an offtake too early, and they can give you advice on the pricing and things like that. So yeah, highly encourage startups to do that.
I would say absolutely. And I think that there might be maybe a little bit of reluctance from founders to go and talk to these big banks. And it can be like a daunting process, right? Like, oh, like the big banker or whoever else that you need to go and sit across from and talk about your technology company that's maybe like 2 or 3 years old. I think that that's important to have those discussions, to go and talk to the banks, to go and talk to the insurers, to go and talk to whoever else it is as early as process, because as much as they're also underwriting your technology, they're also underwriting some of your performance as an individual. So it's good to develop some of those relationships.
Yeah. Another thing that Barclays mentioned in my conversation with them was the engineering firm. They care very much which engineering firm that you engage with. So that's also important. And that's something that you should talk to them about as well before locking in something. Can you explain to me what the difference is between an advanced purchase agreement versus advanced market commitments?
Sure. So an advanced purchase agreement pairs a specific project with a specific buyer for whatever the given output is, while an advanced market commitment incentivizes projects to deliver some sort of output to a pool of buyers. So both of these, both the advanced purchase agreement and the advanced market commitment, are forms of offtake and are legally binding, but the advanced market commitment sort of takes this extra step to guarantee that there is a viable market for whatever the output is, and can help to overcome some of the high upfront development costs that are associated with building some of these projects or creating some of these technologies. And this was really pioneered with the pneumococcal vaccine, where a bunch of buyers got together and said, or the government sort of said, we want to get this vaccine. Whoever's able to produce this thing, we are here, and there's X amount of dollars available once you are able to deliver it. proven climate technology projects with some of the lower development costs, like renewable energy, they might be a little bit more fit for advanced purchase agreements, while some of the more novel climate projects with some of the higher development costs right now, like carbon removal, would probably be more of a fit for advanced market commitments. And so I can give an example of each of these, which is in energy markets, which have been around for almost a century, there are more standardized offtake agreements, which in renewable energy is called like a power purchase agreement or a PPA. And this market has grown an enormous amount over the past few years. So in 2021, corporate buyers, I think, purchased somewhere above 30 gigawatts of clean energy through PPAs. And that number, procured gigawatts, is just expected to go up with time. And so PPAs have sort of become the standard for offtake in electricity markets and help to really boost that adoption for renewable energy. In carbon removal, you'll see more for some of these advanced market commitments. So the best example is Frontier Climate, which assembled this group of buyers a year or so ago to signal that there was demand for these carbon removal credits. And so Frontier's advanced market commitment, or AMC, comes from Stripe and Alphabet, Shopify, Meta, McKinsey, and probably some others that I'm forgetting. And what they did is they're signaling that there's an initial purchase of $1 billion plus of credits over the course of this decade, which can help to show to all these project developers that somebody's going to buy your output once you produce it.
Right, that there's demand.
Exactly. And so that's what it can basically say is like, hey, there's not just a small market for this sort of thing, there's a big market for it. And if you build it, we will come, sort of thing.
This has come up a lot. When I went to the Carbon Unbound, which is a removals conference, they talked a lot about like de-risking and how do you de-risk and who can step in to help de-risk so the banks can come in. And that's where it's early days for some insurers, but for some products, you can have insurance. But how have governments stepped in to de-risk some of these agreements? And are there other sort of nonprofit organizations that are also stepping in?
Yeah, so every once in a while, you will see governments step in to facilitate offtakes and help to adhere to some of those projects. So there are a few examples of branches of governments that have done that. So in the UK, there's the Low Carbon Contracts Company, or the LCCC. And in Germany, is something along the lines of the Federal Department of Economic Affairs and Climate Protection, which I'm not even going to try. I'm not even going to try to pronounce what the German version of that is, but I think the acronym is BMWK, which is also funny because BMW is in the middle of that. And so what they do is they offer these contracts for difference to a lot of the renewable or low carbon energy generators. And what they help to do is to protect some of them from wholesale price volatility. And they also end up protecting the consumers from paying to support some of the high upfront development costs of renewable projects. In the US, we've also seen some advocates for some similar structures. So people have started talking about other transactions, or OTs, which are these government agreements that are quote unquote other than, hence the OT,
okay,
a traditional contract or grant. And those can take form as an offtake. And so sometimes governments can have a clean energy agenda, and these schemes can help to support sustainable energy producers like wind or hydrogen or you name it. The government can also sometimes be customers or provide loan guarantees. So in the US, the great example is the US Department of Energy's loan program office that Jigar Shah leads. So governments can de-risk in other ways that aren't just necessarily on the buy side.
Right. So that's when the governments are issuing loans, you mean? That's what...
Exactly. Yeah, they can be debt providers too.
Yeah. Can we go through some more examples? I know that you already gave some really good examples, but maybe just to provide a little bit of color, like maybe just very high level, like in sustainable aviation fuel or hydrogen or even removals. Yeah. Could you give us some examples?
Yeah, I can give you a couple, and I'll try to reference these off the top of my head. But one that I saw recently, I think in September it was announced, was United Airlines signed an agreement to buy, I believe it was 50 million or maybe 60 million gallons of sustainable aviation fuel, like annually for the next 20 years, from a company called Semvita. So that was one where you see sort of airlines stepping up, and there are also different regulations that are pushing that, like Corsia, which is also like where there's ongoing discussion about how to use sustainable aviation fuel and carbon removal to help to decarbonize the aviation industry. For hydrogen, based on some analysis by Bloomberg New Energy Finance, there are very few binding offtake agreements, but this is a place where you might see more coming out, especially as governments like the US Department of Energy has stepped in and sort of begun talking about whether a nonprofit entity can be created to create demand certainty for hydrogen. I've seen, as I mentioned earlier, very few offtakes in cement and steel just because those buying cycles are different than like fuels or
Right.
energy.
Shorter. Yeah. They have like more immediate needs.
Exactly.
And then, of course, there are removals, offtake agreements. So, like Microsoft could sign an offtake agreement with an enhanced rock weathering company, or we see quite a few of those. So, I know that you relied on a number of resources to write the paper. Are those resources that startups could also use if they've never structured an offtake agreement? And could you name a few?
Yeah, sure. So some of the ones that I listed at the end are more for helping to characterize this first of a kind financing gap and aren't necessarily about offtakes specifically. I would actually look at some of the footnotes for where I hyperlink articles from the big law firms because they probably have more authority on this topic than even I do about what those should look like. But I definitely relied on the help of my friends in terms of writing this. So the folks that helped to review were folks at, the U.S. Department of Energy, Munich Re, which is a big reinsurance company, Spring Lane Capital, which is a project financier. And then some of the work was influenced by a lot of like fellow climate folks. So Elemental Accelerator has written a lot about this topic. Prime Coalition has written about it. The other paper I think I linked to was New Energy Risk. And then there's a handful of other project developers and folks that I talked to from banks, including banks and other folks.
Great. So then I would just recommend that people go into the show notes, click on the report, and then go all the way to page 17, which is at the end, and look at the acknowledgments. So what's next for CREO? I heard that you guys are writing a few more reports. What's coming out next?
Yeah, so I do have a handful of these other ones coming out. So the next one coming out will be on risk transfer solutions, which should hopefully be published in the next couple of weeks relative to when we record this is February 8th for folks' reference. So that one will be about derivative agreements and insurance contracts and how those can be helpful in absorbing different types of risk from projects. The one that I'll write after that will be on, when we were talking about this earlier, some of the EPC contracts and the engineering firms and what those should look like in terms of helping to build some of these. And then there will be a handful of others that I think will sort of come down the line. There will be one on debt tranching, so like where does mezzanine debt fit in versus first loss capital. And then I think sort of the capstone piece that I'll end up writing will be very relevant to some of the CREO community on the role of catalytic capital and what it can do to help to build some of these first of a kind facilities.
Oh, good. I have first dibs on the mezz and the catalytic capital, please.
Tammy, I already promised to you I'm not going anywhere else.
And it's on the record.
Dedicated guest right here.
All right. Well, before you go, I always like to ask people where they think the low-hanging fruit is in climate tech. So areas that have potential to have outsized impact that people aren't really focusing on because they're way too focused on the crazy cool technologies like solar geoengineering. Yeah. So where do you think the low-hanging fruit is?
I mean, some of the stuff that I find most interesting, which I wouldn't necessarily say is the low-hanging fruit, is like just energy storage in general. I just think it's some of the big topics. Like I'm always fascinated by batteries and think that there can be a lot of winners in that space and finding different ways to deploy energy storage. So, somebody might have a battery on site and they need to bring on more batteries. Like how are you able to do that? I think there's also some opportunity in just like climate fintech and thinking about how to more appropriately price risk, whether it's just climate risk in general, whether it's physical risk or transition risk. Candidly, I am an advisor to a company on that topic, and I've always found it interesting, specifically coming from more of that climate risk hedge fund background. And then the last one I would say is chemicals or other solutions that can help us with recycling and reusing metals or critical minerals.
Well, thank you so much, Kobe. This was really, really helpful. And hopefully it's going to be helpful to you too, because I'm sure you get a lot of questions around offtakes, and now you can just send people the link to the podcast.
Exactly. This can be my voiceover, my audiobook for the paper. So yes, I will definitely be sending this one around.
And that is it for this episode with Kobe Weinberg. If you found it useful, please subscribe and write a positive review because it helps people discover the podcast. Thanks for listening and catch you at the next one. Bye, everyone.